everyone, and welcome back to my channel. For today's topic, we're going to discuss why real estate is connected to financial stability. We're not in Palm Springs today, but we're back here in San Diego, the first property that I purchased back in 2019 at 23 years old. One-bedroom condo here in North Park. It's close to downtown Balboa Park. My renters recently moved out, so now it's time to make some adjustments here at the condo. Having this condo from 2019 has allowed me to be financially stable for this entire time that I've had this condo and bought the property in Palm Springs. It all starts with your first property, and as a real estate agent, I have to tell you, it is harder to buy your first property than it is to buy your second property. Because when you buy your first property, it's your first time in the game, you don't really know what's going on, but then you really start to build up. So we're gonna talk about why real estate creates financial stability. If you could please like and subscribe, and also comment below on other video topics you would like for me to discuss in the future. Now, there's a difference between financial stability and financial freedom. The idea of financial freedom is like having a lifestyle of abundance, flying anywhere that you want to go, having residual income, this source here, this source there, all of that, right? But what I'm really talking about is financial stability. For me, financial stability is the idea of maintaining your current lifestyle while being able to absorb unexpected debt monthly or yearly. So that way you're able to maintain a sustainable lifestyle throughout the entire year. This is not to live of abundance. This is to maintain your bills, your debt, potentially have sources of income additional that can help you with your day-to-day monthly expenses. When I purchased this property back in 2019, I was able to lock it in at a price of $310,000. As you can see right now on Zillow, Redfin, you look at the average one-bedroom condo for sale in this zip code, and it's about $450,000 to $500,000. Definitely was the best decision in the long term. Locked in my mortgage payment, which is right around $1,700 a month. Including the HOA here at the condo, it makes it about $2,000 roughly a month. Again, the stability started when I first bought. I had renters that came in back in 2021. I gave them a really good deal on the property, rent of $1,750 a month, so I was kind of taking some of the loss. But then as the time went on, a year, I increased the rent another $100, and then the final year, another $100. So I essentially broke even and had no debt with my mortgage here at the condo. And now that I have a chance to rent it out again, I'm definitely going to be looking closer to $2,500, maybe $2,600 a month. Just depends on what you can get for the area that you're looking to rent. Now, with financial stability, how do you create that? How do you make that? Let's say you are in the position where you're buying your first property and you're questioning if you should buy it, if you should wait. Let's go over the reasons why you should buy a property and how it can help you create financial stability today. Please like and subscribe, and also comment below on other video topics that you would like for me to discuss in the future. Now, how can real estate help you create financial stability? The first way is it helps you lock in your monthly payment when you are paying for your mortgage. Now, when you're renting, you know that you have these increases every year. If you are a renter, typically you get at least a $50 increase here, a $75 increase. Sometimes you get a $100 increase when you're renting a property. If you do have an option to purchase a property and you talk with your lender and you look at your loan estimate, even if the interest rate is a little higher, you can afford the monthly payments. You are not going to be stressing financially monthly. If you can afford it, lock in. Even if the rate is high, we'll talk about the high rate later in this video. Going back to the stability and locking in your monthly payment, that creates stability from the beginning. You don't have to worry about an increase on your monthly payment next year or the year after that, or when your lease ends. In this situation, if you're getting a fixed rate, then your monthly payment doesn't change with your purchase. Now, if you lock in and you are able to rent out the property, let's say in 3 years, the average rent in your area is $4,000 for the same condo that you lock your monthly payment at around $3,200. You follow me? Which leads me to my second benefit. You get to leave the property and make it a rental property, gives you increase in income. Now, in a couple of years, you're most likely able to rent out your property for maybe $500, $600 in profit. This will help you cover other bills and expenses, and this helps you if you are looking to move out of the property in a few years. This will allow you to potentially get another source of income when you purchase your second property or when you want to move out of this property that you first bought. A lot of times people, within 5 to 7 years, they'll leave their first property to get a bigger home. Maybe they're raising a family, they have new kids, they want just more space in general. So this is a common thing within 5 to 7 years of people moving if they're able to. If you have your first purchase that you bought, let's say it's a condo like this, 1 bedroom, it was your starter home, now you have a family coming on the way, now it's time to buy another property or sell this one. If you sell it, great, you make some profit, you can go buy a bigger home. Or you can rent out this property that you first purchased, rent it out, and have another source of income when you are ready to buy your next property. Let's just say you can rent out your place for $4,000 a month, the first property that you bought. If your mortgage is $3,200 a month, it's going to cover the debt, so your debt to income ratios will be lower when you're able to purchase for your next property. Does that make sense? There's a lot of information that I just threw out to you. It obviously eliminates your debt when you're doing debt to income with your lender, so you're going to have a higher chance to purchase another property by keeping that first property as a rental property. You have to live in the property for a few years. You can't just purchase your property and then get it rented out, because if it's considered a primary residence, you do not want to break the law with your loan. If you're getting a primary residence, make sure you're living in the property for at least 2 to 3 years. You can continue to pay down the loan amount on your first property and use equity in the future. When you lock in your interest rate, the loan, you pay a part of it to interest and to principal. Interest, unfortunately, when you're paying your monthly mortgage, it's just going to interest, and that's why a higher rate really sucks, because the interest does not go to pay down the loan. Your principal is the bread and butter. That's the amount that actually lowers the loan amount for your property. That's where you really want to eliminate the amount as much as possible. So if you're able to put an extra $50, $75, $100 towards your principal, that could help you pay off your property quicker. But let's go back to the reason why that's a benefit. Let's just say in a few years your property is worth more than what you bought it for. That means that there's equity potentially in my property, meaning that the value now versus the actual price that I bought it for, there's a little gap in between, which is equity that I could potentially pull out and use for a remodel of the condo. I could use that money to potentially buy another property. And that's what happens when your property values increase after 3, 4, 5 years. Now, the easiest way to do this is by doing what's called a HELOC, which is like getting a third loan on your condo. So that's just a FYI. You can pull out the money, but it is considered like a loan. Or you could do a cash out refinance where it's the same loan, it's just one loan and it's restructured, but you can only do a cash out refinance if the interest rates are lower than the current rate that you have. I was talking about in the beginning of the video, if you do have a higher rate that you're really not comfortable with, but you know you can make the monthly payment, lock in that monthly payment, buy that first property, create financial stability. If you're able to lock it in at that time, and the rate that you have, let's just say is 6%. In 3 years, the rates go to 4%. That means you're able to do a cash out refinance to get a lower 4% interest rate, right? And at that time, you can pull out money if you have equity in your property. So again, there's a lot of benefits with owning your first property. If you are sacrificing space, but you know you can live in the place for 3, 4 years, you know that the monthly payment is really good for you, lock in, get your place, because it's going to allow you to buy maybe another property or have money set for your family, for future expenses, for anything that you just don't know what you're prepared for, right? So thank you again for watching, and until then, go be amazing.